Take a look out that window, and what you see is another beautiful day here in South Florida. Here I am, Kenny Polcari, with my Dunkin' Donuts coffee, of which I've only had the one cup so far, so I got more to go. I am your host of the party, and today is Friday, April 22nd, 2022. And here are the things that you need to know about what happened yesterday and what's going to happen potentially today as we move into the weekend. Did Jay hint at something more than 50 basis points yesterday in his conversation? Christine Lagarde from the ECB also jumping on board. Markets went into reverse after that commentary. NASDAQ lost another 2%. Investors are raising cash from outperformers. Doesn't mean anything other than they're raising some cash. Oil churning at $102. Lonnie now has $46 billion to take Twitter private. So let's see what happens now. And what are we having for dinner? We're going to have the grilled pork chops with sweet vinegar peppers. Yum. Okay, so look, it was a tale of two cities yesterday. In fact, it's been a tale of two cities since the start of the year. NASDAQ and the sexy high growth names under fire, while the bigger boring names have offered shelter from the storm. And while for the most part there hasn't been a broad market meltdown, there has been turmoil. NASDAQ now down 16% on the year, double that of the S&P and 4 times more than the Dow. The talk at the beginning of the year of gentle 25 basis point rate hikes and a slowing of the bond buying has turned into 50 basis point hikes and a swift reduction of the $9 trillion balance sheet. Every member of the Federal Open Market Committee all now jumping over the fence and are in the same "the Fed has to be more aggressive" camp. And then the Fed had their plants, think Goldman and BlackRock, etc., doing all that they can to convince us that while 50 basis points was necessary, it was not a game changer at all. Nothing to see here, nor is there anything to worry about. Move on. Rising rates are good for the U.S. economy. And then the macro data continues to weaken. Inflation now printing at 40-year highs with no end in sight, even as much as they try to convince us that it's all transitory. Weakening PMIs and falling average hourly and weekly wages only adding to the angst. Mortgage rates are now up more than 70% in 3 months, and that's begun to put the brakes on the red-hot housing market. And the Fed hasn't even started to raise rates yet, right? Imagine what happens to mortgage rates when the Fed actually begins to raise rates. 10-year treasuries having spiked higher as well during this time. Bids disappearing as the Fed is no longer the buyer of last resort, and at least that's what they're telling us, right? And that has sent yields surging, taking them from 1.6% to 2.98% in less than 3 months. Along the way, we did have a bunch of inversions in the bond market, and that led so many to predict that a recession was now a real possibility. And it's at some point in the future, which is really comical. Why? Because it's not a possibility. It is a reality. A recession is coming. Just put that in your back of your head, right? And it's not a reason to create panic. It's just a fact. It's also not a reason to jump out the window. It just means prepare yourself by getting ready for this event, right? Now look, and then on Monday, once again, we had St. Louis Fed President Jimmy B floating the idea that the Fed needs to be even more aggressive, suggesting that a 75 basis point hike is on the table, which is code for 100 basis points is really under consideration as well. And that put additional pressure on the NASDAQ as the algos hit the sell button and moved money further into the value and defensive sectors. And then yesterday, Jay Powell was at some roundtable event with Christine Lagarde of the European Central Bank fame and made it clear that 50 basis points was on the table, all while Lagarde suggested that she was about to get tough on the out-of-control European inflation as well. And the market suddenly went south. Why? It's no big deal, right? They've been telling us that for months now. The market had it priced in, 50 basis points, no big deal. Goldman assured us that it's nothing to worry about. So then why did the Dow and S&P suddenly get weak? Was Jay suggesting something else? Was the Jimmy B commentary earlier in the week becoming a reality? I mean, if it's really 50 basis points, then we shouldn't have had that much of a reaction. Yet we did. And by 4 p.m., we saw the Dow off 370 points or 1%. The S&P giving up 65 or 1.5%. The NASDAQ got slammed down 280 or 2%. The Russell took it on the chin, falling 47 points or 2.3%, while the transports fell 55 points or 0.5%. And so what that tells you is that the market is not convinced that the narrative is the narrative. Fed fund futures are now pricing in a 50 basis point hike in May and a 75 basis point hike in June. But much of that is going to depend on what the next CPI and PPI reads are, right? And don't expect them to have peaked. They haven't. Next month's CPI has to react to last week's 11.2% PPI print. So don't think this is over just yet, which is why we are now discussing 75 and possibly 100 basis point hikes in the not so distant future. And that is not priced in, at least yet. And the only way it will is if the market reprices that new outlook, which is what it is doing. Every sector was under pressure yesterday. Energy down 3%, communications down 3%, basic materials, tech, and utilities all down 1.5%. Industrials, healthcare, consumer discretionary down 1%. Consumer staples flat on the day, which is a win, right? Money moved into the staples. What have I been telling you? Metals and miners, the XME ETF lost 6%. Steel, SLX ETF lost 3%. Oil services, OIH, lost 4.5%, which makes sense because traders and investors are taking profits in the sectors that have outperformed so that they have cash available. Remember that year to date, the XLE is up 44% in a down market. XME is up 40%. The steel index is up 29%. OIH up 60%. So it makes complete sense in an anxious market. The coal stock BTU got whacked down 12%. CRK natural gas lost 4.7%. But again, investors are ringing the cash register. BTU was up 183% year to date, while crack was up 112% coming into yesterday. And so when the tone gets ugly, investors will take profits first in sectors that have outperformed versus selling sectors that are already under pressure, which is why the weakness in those particular names is not a surprise. Capiche? Then add in the geopolitical crisis that's taking place and the latest lockdowns across China due to COVID, and you add in all kinds of supply chain issues and ripple effects to the conversation once again, which is not seen as bullish. Talk of empty shelves for back-to-school sales, and yes, the Christmas shopping season are already taking place in the media as they try to ramp up the level of angst so that you feel compelled to go shopping now just so you have back to school clothes and toys, God forbid, under the Christmas tree. Are you kidding me? Economic data today includes both manufacturing and services PMIs, right? The purchasing managers indexes, and they are both expected to report 58, which is an expansionary territory. So this will be another key metric as it speaks to the health of both of those sectors. And remember, the U.S. is a 75% services economy. So the services PMI is the one to watch. I mean, they both are, but the services one you should watch. Earnings today includes Cleveland-Cliffs. They beat. You got Slob, HCA, Kimberly, you got Verizon. Oil continues to churn right in here at $102 a barrel, holding above the trend line at 98.96. U.S. futures are all under pressure this morning. The Dow's down 125, S&P's off 15. The Nasdaq's down 45, and the Russell's off by 6 points. Now look, on a side note, guess what? Lonnie Musk has commitments for $46 billion, which is $3 billion more than what he originally bid to take over Twitter. Let's see what happens now. What will the board say? Now, don't be surprised, but Twitter is quietly changing the settings on their algos to make it look like they're not censoring the conversation just in case Lonnie succeeds. So who's kidding who? I mean, come on. Let's be serious. European markets this morning are lower. Fed and ECB commentary causing some of the angst. UK retail sales data disappointed. French luxury retailers taking it on the chin for both what's happening in Europe as well as what's happening supposedly in China. The rumor this morning being that Chinese women are unable to run out and purchase luxury items because they're locked in their apartments. So luxury maker Kering loses 5% on that story. I mean, it's comical. French elections are also putting pressure on investors. Voters are heading to the polls on Sunday to choose between Emmanuel Macron or Marine Le Pen. Goldman telling us that this is a decisive moment in French history. Every election is a decisive moment. At 7 a.m., markets across the region are all down better than 1.5%. Now look, yesterday the S&P closed down at 43.93, down 370 points in a major reversal, breaking down and through the 50-day moving average trend line at 44.12, leaving us once again below all three trend lines as we approach the May Fed meeting, and 10-year treasuries once again attempting to kiss 3%, all while Jimmy B hinted a 75 basis point rate increase, which I think really means 100. And Jay Powell attempts to tell us that we're only in for multiple 50 basis point increases. So it's all very confusing. And that screams that someone isn't being honest with investors and Americans. I mean, yesterday, Jay revealed that the job market is too hot. It's unsustainably hot. His words, not mine. Showing clear concern for what is coming. Again, like I've been saying, one of two things is going to happen. Either the administration and their talking heads are going to tell us how great 3% is for the economy and rising rates are good and there's nothing to worry about, or a breach at 3% is going to ignite a firestorm of selling as the reality of higher interest rates takes a further toll on the economic recovery. Either way, there is always an opportunity for those that are paying attention. In the crypto space, Bitcoin's churning, trading right again at 40,000, and Ethereum is trading at 3,000. They just can't seem to get out of their own way. They've been kind of dead money here for a couple of months now, right? Okay, so what are we having for dinner? We're having grilled pork chops with sweet vinegar peppers. Now, this should cost you about $45 to feed a family of four, right? Yeah, $45, I think. You buy the nice grilled, the nice thick cut pork chops, right? It's an easy dish and not one that you might readily think of, but make it easy on yourself, right? You only need really four things to this. You need the center cut, bone-in, thick pork chops. You need olive oil, sweet vinegar peppers, right? You can use hot if you want. I prefer sweet. You need salt and pepper and some chopped scallions. Preheat the grill. Get the grill really nice and hot. Rub the chops with olive oil. Season it with salt and pepper. Massage it all in, right? Let them sit for a minute. When you're ready, place the chops on the grill. Sear on one side for about 3 minutes and then turn them over. Continue cooking for about another 4 minutes or so, depending on the thickness, right? You'll know. Make sure you don't burn them, right? Just be there, don't leave them. While the chops are now cooking, you want to open the jar of sweet vinegar peppers, kind of slice them up, saute them quickly in their juice in a saute pan. You just really want to warm them up. You're not cooking them. You just want them to be hot. Now, when the chops are done, take them off the grill, put them on a warmed plate. Top those with the sweet vinegar peppers in the sauce, right? And take the scallions and just drop them on top. You want to serve this with a large salad, something simple, mixed romaine, some spinach, maybe some Boston bibs, sliced red onions, tomatoes, cucumbers. Dress it in a simple balsamic vinaigrette. There's no reason to get complicated here. It's all about the simplicity in this dish, and you're going to love, if you do it right, you're going to love these pork chops with sweet vinegar peppers. Look, it's Friday morning. I'm going on Stuart Varney at 9 o'clock, Fox Business. Make sure to tune in because I'll be the guy with the beard on the screen. In any event, have a great weekend, and I'll see you on Monday.